Warren Buffett, the Oracle of Omaha, is a name synonymous with investing success. His journey from a young boy with a keen interest in numbers to one of the wealthiest individuals in the world is nothing short of extraordinary. His legendary status is not a result of mere chance or intuition. Instead, it is the culmination of years of disciplined investing, rigorous analysis, and a steadfast commitment to his principles. It's the product of a disciplined approach to investing, deeply rooted in the principles he learned from his mentor, Benjamin Graham, the father of value investing. Graham's teachings provided Buffett with a solid foundation, guiding him through the complexities of the financial markets. Graham, a Wall Street titan, revolutionized the world of investing with his groundbreaking book, The Intelligent Investor. This book, often referred to as the Bible of value investing, laid out the fundamental principles that would shape the investment strategies of countless investors. This seminal work introduced the world to value investing, a philosophy centered on finding undervalued companies with strong fundamentals. It emphasized the importance of thorough research, patience, and a long-term perspective. Buffett, a devoted student of Graham, absorbed these principles and went on to build his empire, Berkshire Hathaway, upon this foundation. Under his leadership, Berkshire Hathaway transformed from a struggling textile company into a diversified conglomerate with interests in various industries. He credits Graham with shaping his investment philosophy and attributes much of his success to the timeless wisdom imparted by his mentor. Buffett often speaks about the profound impact Graham had on his life, both personally and professionally. This essay delves into the core principles of value investing that Buffett inherited from Graham. It explores the key tenets of this investment approach, such as the margin of safety, intrinsic value, and the importance of focusing on the long-term potential of investments. It aims to equip you with the knowledge and tools to navigate the complexities of the market and make informed investment decisions. By understanding and applying these principles, you too can aspire to achieve financial success and stability, much like the Oracle of Omaha himself. Value investing is not about chasing quick profits. It's a disciplined approach that requires patience and a deep understanding of the market. It's not about following the latest market trends or getting caught up in the hype of the moment. Instead, value investing is about adopting a long-term perspective. It's about focusing on the intrinsic worth of a business and buying stocks when they are trading below their true value. This means looking at the fundamentals of a company, such as its earnings, dividends, and growth potential. Imagine buying $1 for 50 cents. This is the core principle of value investing. That's the essence of value investing. It's about finding those hidden gems in the market that others have overlooked. It's about identifying undervalued assets in the market, companies with strong fundamentals, but whose stock prices don't reflect their true worth. These are companies that have the potential to grow and generate significant returns over time. Value investors are like detectives, meticulously analyzing financial statements, assessing management quality, and understanding a company's competitive edge to determine its intrinsic value. They look for companies with a strong balance sheet, good cash flow, and a sustainable business model. They dig deep into the financials, looking at everything from revenue and profit margins to debt levels and return on equity. They also consider qualitative factors such as the company's brand, market position, and management team. Value investors are patient and disciplined, waiting for the right opportunities to buy low and sell high. They understand that the market can be irrational in the short term, but believe that over the long term, the true value of a company will be recognized. This approach, while seemingly simple, requires a shift in mindset. It requires a willingness to go against the crowd and to be patient, even when the market is volatile. It requires looking beyond the daily noise of the market and focusing on the underlying value of a business. This means ignoring short-term price fluctuations and staying focused on the long-term potential of your investments. It's about being greedy when others are fearful, and fearful when others are greedy. This contrarian approach can be challenging, but it is the key to successful value investing. By staying disciplined and focused on the fundamentals, value investors can achieve significant returns over time. One of the cornerstones of value investing is the concept of intrinsic value. This concept is fundamental to making informed investment decisions and is often what separates successful investors from the rest. Intrinsic value represents the true worth of a business, independent of its current market price. It is an objective measure that helps investors determine whether a stock is overvalued or undervalued. Determining intrinsic value involves a thorough analysis of a company's financial health, its management team, its competitive landscape, and its future earnings potential. This process requires a deep dive into various aspects of the business. Investors look at the company's financial statements, including balance sheets, income statements, and cash flow statements, to get a clear picture of its financial stability and performance over time. Think of it like assessing the value of a house. You wouldn't just look at the asking price. You'd consider its location, size, condition, and recent comparable sales to determine its fair market value. Similarly, in the world of investing, you need to look beyond the surface. You'd also take into account the neighborhood, the quality of the construction, and any potential for future appreciation. All these factors contribute to a comprehensive understanding of the property's true value. Similarly, value investors delve into a company's financial statements, scrutinizing its assets, liabilities, revenues, and profits. They look for consistency and growth in earnings, as well as the company's ability to generate cash flow. They analyze its management team, evaluating their track record and decision-making abilities. A strong, competent management team can significantly impact a company's success and, consequently, its intrinsic value. Evaluating the management team involves looking at their past performance, their strategic vision for the company, and their ability to navigate challenges and capitalize on opportunities. They study its competitive landscape, understanding its market share, pricing power, and potential threats. Knowing how a company stands against its competitors is crucial in assessing its long-term viability and growth prospects. By piecing together this information, value investors aim to estimate a company's intrinsic value, a realistic assessment of what the business is truly worth. This comprehensive analysis helps them make informed decisions about whether to buy, hold, or sell a stock. Understanding intrinsic value is not just about numbers, it's about understanding the story behind those numbers. It's about seeing the bigger picture and making investment choices that align with long-term goals. In essence, intrinsic value is the bedrock of value investing. It empowers investors to look beyond market noise and focus on the fundamental strengths and weaknesses of a business. By mastering this concept, investors can build a robust portfolio that stands the test of time. Section 4. The margin of safety, your financial buffer zone. Investing, even when based on thorough analysis, carries inherent risks. Market sentiment can shift, unforeseen events can occur, and even the most promising companies can face unexpected challenges. This is where the margin of safety comes in, a crucial principle that sets value investing apart. It involves buying stocks only when their market price is significantly below their intrinsic value. Think of it as a buffer zone, protecting your investment from potential downside risks. By buying with a margin of safety, you are essentially buying a dollar for 50 cents, creating a cushion for potential errors in your analysis or unforeseen market fluctuations. This principle emphasizes the importance of being conservative in your valuations. It's about acknowledging that you can't predict the future with certainty, and that a margin of safety is crucial for mitigating potential losses. Section 5. Weathering the storm, embracing market fluctuations. The stock market is like a roller coaster with its inevitable ups and downs. Value investors, however, view these fluctuations not as threats but as opportunities. They understand that short-term market sentiment is often driven by emotions, leading to mispricings and creating opportunities to buy undervalued assets. Imagine a sudden downpour causing people to sell their umbrellas at a discount, even though the rain is temporary. Value investors recognize such irrational behavior and seize the opportunity to buy valuable assets at bargain prices. They remain focused on the long-term fundamentals of the businesses they invest in, understanding that market fluctuations are a natural part of the investing journey. They are patient and disciplined, waiting for the right opportunities to buy low and sell high. This ability to remain calm and rational amidst market volatility is a key characteristic of successful value investors. Section 6. Staying in your lane. The circle of competence. One of the most important lessons Buffett learned from Graham is the importance of investing within your circle of competence. This means focusing on industries and businesses that you understand well, where you can confidently assess their intrinsic value. It's about recognizing that you don't need to be an expert in everything to be a successful investor. Instead, focus on developing a deep understanding of a few industries or sectors where your knowledge and insights give you an edge. Imagine a skilled carpenter trying to build a rocket ship. While proficient in woodworking, their lack of expertise in aerospace engineering would likely lead to disastrous results. Similarly, investors should stick to areas they understand, where they can confidently analyze companies, assess their competitive advantages, and make informed investment decisions.